Good evening, Kalyani ma'am.
Good evening, sir. Am I audible, sir?
Yes, ma'am, you are audible. Good evening, Kripa ma'am. Ma'am, please unmute ma'am.
Good evening, sir. Good evening, ma'am.
Good evening, ma'am.
Okay, can we start the session, ma'am?
Yes, sir.
Yes, sir. Okay.
Yes, yes, ma'am.
Okay, sir. Good evening to one and all present here. Welcome you all for the third day of our workshop on financial statement analysis with the blessings of Puja Mahaswamiji, due respect from our principal and constant supporter of department head Dr. Mamata Ji. I take this opportunity to welcome our today's speaker, Miss PALNS Kalyani. Welcome you, ma'am. Miss Kalyani, ma'am, working as Dean Academics with St. Mary's Sentency College at Sikandarabad. She did her MBA, MPhil, and PhD, and has 19 years of teaching and industrial experience. She has 38 publications on her credit, authored 3 books in the area of accounts and finance, 17 papers with ISBN, and 18 papers with ISSN, including 4 UGC approved journals. She presented 37 papers in various conferences and seminars, 10 in international conferences and 27 in national conferences. She has certification to her credit in the area of digital marketing, monitor online training from BYST CII, outcome-based education, entrepreneurship empowerment, and skill development, startup enablers training, etc. She participated in more than 60 workshops and FCBs, organized many seminars, conferences, workshops, etc. in her capability of convener. Ma'am has an achievements like awarded with She Inspires by Be the Change on occasion of International Women's Day on 8th March 2020 and awarded as a best faculty of entrepreneurial research by Ambitions Award of for Education Excellency in 2020 on 25th January, awarded as a best coordinator by Spurti Engineering College, and also awarded as a best NAC coordinator at Spurti Engineering College, and awarded as a best teacher on 2011, 2013 and 14 in Joseph P.G. College and Spurti Engineering College. Ma'am, it's a great pleasure that you are in our workshop. Welcome you, ma'am.
Thank you, Krupa, ma'am.
Yes, ma'am.
Okay,
Over to you, ma'am.
Okay, ma'am. So, good morning and warm welcome to all the participants. Good evening and warm welcome to everyone for the 5-day workshop cum certification program for the students on an analysis of financial statements organized by SJB Institute of Technology, Bangalore. First of all, I would like to thank the management of SJB Institute of Technology for giving this opportunity and also organizing this wonderful program for the benefit of the students. And I also thankful and grateful to Dr. Kuttaraju, the principal of the college, Dr. J. Mamta ma'am, the professor and HOD of MBA department, Professor Brijesh, the coordinator of this particular program, and greetings of the day to all the participants. So welcome to this particular workshop. And today I'm going to give a presentation and talk about the ratio analysis as a part of financial analysis. So let us have a look at the concept. So first of all, what do you mean by ratios? A ratio is a simple arithmetic expression of the relation of one number to another. It is an expression of quantitative relation between two numbers. For example, if you take in a class of 60 members, the number of boys in a class is 45. And then let us say the number of girls in the class is 15. So what is the ratio of boys and girls in the class? So there are two different variables. Boys are one variable and girls are another variable. So what is the relation? What is the majority of how many boys, how many girls are there? If you take this particular measurement, 45 is to 15 is 9 is to 3, that is 3 is to 1. For every 3 boys, 1 girl is there. So the majority portion of the boys, the majority portion of the members are boys in the class. Like that, between any two variables, what is the relation that is going to be existed is going to be given by the ratios. So what do you mean by financial statements? So the financial statements are written records that convey the business activities and financial performance of the company. So as a business, you would like to know how you are operating the business, for which you are going to maintain the accounting records. So do you know, all of you know the art of accounting. Accounting is the art of recording, classifying, summarizing, then reinterpreting the results, the financial results in a which the transactions which are financial in nature. So after preparing so they are part of the financial statements, because those financial statements explains what all the activities that happen in the company, how much sales have taken place, how many purchases have taken place, how many assets have been purchased, what are the liabilities, how much interest have been paid on the liabilities, what are the debentures, how much equity has been borrowed, how much equity funds have been raised, how much debentures debt has been borrowed from the outside organization. Like that, everything what happened in a particular financial year will be reflected in the financial statements. So generally these financial statements are often audited. First of all, there are two types of audit everyone knows. One is the internal audit and the other one is the external audit. So after it is being certified by the external auditor, it is also being audited by the government agencies like income tax departments, accountants, firms, to ensure the accuracy. It has to be accurate. It has to be, they are supposed to be transparent, and they have to be available in the company's website. The annual financial statements have to be available to all the stakeholders of the company, both the internal stakeholders and the external stakeholders, and they have to be published in the newspapers and financial journals. So to maintain the accuracy for the tax, financing and investment purpose. So these are called the financial statements, which are the written records. They are mostly quantitative in nature. So what do you mean by financial statement analysis? First of all, we will know what are the financial statements in an organization. So in the accounting cycle, first we'll prepare the journal. From the journal, we post the entries into the ledger. We'll summarize the ledger balances. We'll prepare a trial balance. From the trial balance, we prepare the trading, profit and loss account and the balance sheet. So the trading and profit and loss account is often called as income statement, and the balance sheet is going to explain us what are the various ways the funds have been raised and the usage of those funds, the application of the funds, sources of funds and the application of funds is going to be reflected by the balance sheet. In the same way, there are some other financial statements like funds flow statement and cash flow statement. In the case of funds flow statement, it is going to explain us how much funds have been generated in the organization, the sources of funds and the application of funds, what are the changes in the working capital position of the organization is going to be reflected, and what are the funds that are raised from the organizations. All these things are going to be discussed in the funds flow statement. In the same way, in the case of cash flow statement, what are the cash inflows and what are the cash outflows? How much cash has been raised from the investment of activities? How much has been raised from the operating activities? How much cash has been raised from the financing activities is reflected through the cash flow statements. So for any stakeholder, these are the various financial statements that are available in the company. Now, what do you mean by analysis? So analysis of the financial statement is the theme of the workshop now. So what is meant by financial statement analysis? Analysis is the process of breaking a complex topic or a substance into the smaller parts in order to gain a better understanding of it. So why it happened, how it happened, when it happened, where it happened, like that we are going to, there is a complex problem. That complex problem is going to be divided into small units, and you are trying to have an answer, and you are trying to have a relation between one variable to another variable. For example, in the financial statement, is there any relation between income statement and balance sheet? Is there any relation between the assets and liabilities? Is there any relation between, again in the assets we have current assets and the fixed assets? Is there any relation between the current assets and the fixed assets? In the same way, in the liability side, we have equity and we have debt. Is there any relation between equity and debt? If there is a relation, what type of relation? Which is more, which is less? What happened if the debt is more than equity? And what happens if the equity is more than debt? Like that, we are going to try to break down the complex topic into smaller parts, and we are trying to make a better understanding to reach a better conclusion. So this is called an analysis. So we are going to deal with the financial statement analysis. So what do you mean by financial statement analysis here is, it is a process of analyzing a company's financial statements for the decision making purposes. So generally in the organizational hierarchy, everyone knows that the lower level management, they prepare the financial statements. So next level is the middle level management. In the case of middle level management, what are the statements that has prepared by the lower management or the executives? They will try to check whether all the things are being prepared by them in a proper way or not. Afterwards, they do the analysis, they interpret the financial statements, they summarize the report and submit the report to the top level management for the decision making purpose. So merely if you present an income statement, merely if you present a balance sheet, no one can understand what is there. So that the figure called profit or the operating income will not reveal the true health of the financial position of your organization. Yes, assets and liabilities definitely are going to be tallied. That doesn't indicate what is your liquidity position, what is the solvency position of your organization. So in order to take a better decision, you need to have a financial statement analysis. In the same way, we have two types of stakeholders in an organization. One is the internal stakeholder, another one is the external stakeholder. Who are the internal stakeholders of your organization? So your employees of your organization, your customers of your organization, or your management of your organization, these are said to be the internal stakeholders. Who are the external stakeholders of your organization? The external stakeholders of your organization are the government, the public, the customers, the tax authorities, bankers, suppliers, creditors. These are the external stakeholders. Yes, do these two people are interested to know the health of your organization? Yes, they are interested to know the overall health of your organization. Why? Because they want to evaluate your financial performance and business value. The stakeholders will retain the funds will in your organization provided your organization is doing well. After analyzing the financial statements, if they understood that your solvency position or your profitability position is not good, immediately they start selling your shares and your market value of the shares will come down. So that is how it is useful for the stakeholders. In the same way, the bankers, even if you take a small loan, income loan, personal loan, for as far as an individual employee or a individual person is concerned, immediately they won't sanction you the loan. What are the documents they ask you apart from the Aadhaar card and PAN card? They'll ask you your income certificate, which is generated by your employer if it is in the case of an individual. And at the same time, they also ask you your bank statement for the past 3 to 6 months in order to know what is the liquidity that you are maintaining in the bank. In the same way, in the case of the organizations, even the bankers ask you to submit 3 years financial statements, your balance sheet, and your apart from the PAN and the Aadhaar or the TAN or your sales tax report or the income tax reports, your statements they are going to ask you. After evaluating your financial performance and your business value or your assets value only, they are going to sanction the loan. In this way, there are many stakeholders who are interested to know the financial health of your organization. So coming to the ratio analysis, there are many financial statement analysis which has been covered from the past 3 days. Another 2 days are left, which may be including fundamental analysis, which may be including the horizontal analysis, the vertical analysis, the comparative analysis, the common size analysis, trend analysis are there. Like that, many analysis are there. So my part is ratio analysis. So what do you mean by ratio analysis? It is a technique of analysis and interpretation of financial statements. First of all, I would like to analyze the financial statements by using few techniques, by using few ratios, and we are going to try to interpret those financial statements. Interpretation means giving a meaning to those financial statements. In the same way, it is the process of establishing and interpreting various ratios for helping in making a better decisions. So you are trying to establish the relation between various variables in your financial statements. The purpose is I want to take a decision. So I want to know whether the profitability position of the company is good or bad, the liquidity position of the company is satisfactory or not, the solvency position of the company is healthy or unhealthy. Like that, many decisions have to be taken. If they are not going in the right direction, what are the steps to be taken to be made by using the ratio analysis. In the same way, it is a means of better understanding of financial strengths and weaknesses of your organization. So the term, as I am telling you, the term net profit doesn't indicate that your organization is a strengthy organization. The term, if you are getting a loss, that doesn't mean that your organization is weak. So you need to compare your present net profit or your operating income with the previous year's figure. What is the progress that has been made? In the same way, your net profit has to be compared with the sales. Your net profit has to be compared with the assets. Your net profit has to be compared with the capital that is employed. So what is the investment that you have put there? And what is the net profit that you got? What is the investment that is made? How much sales have been taken place? Like that, you need to have a better understanding about in which areas I am strong, which whether where I am strong and where I am weak. It will be reflected not only by looking at the financial statements, but by analyzing the financial statements by using the ratio analysis. So, what are the basic objectives of this ratio analysis? If you take the objectives, first thing is it is helping us to standardize the financial information for the comparisons. You can able to compare your progress of your company with from the last year to this year, last financial year to this financial year, 2018 to 2019, 2019 to 2020, like that. You can check whether your company is progressing in a positive direction or not. In the same way, it is also going to have a standardized date. That means everywhere we are looking at the benchmarking. What do you mean by benchmarking? So what are the industry standards? What are the firm standards? Like that, we are going to have a benchmark, or we need to have an ideal ratio, and we are going to check whether your ratio, your assets or your liabilities or your sales are meeting the ideal figure or not, or the targeted figure or not. In the same way, we are going to evaluate your current operations, whether your current operations are satisfactory or not. The present operations of your company, the present operations of the company in the terms of the sales, in the terms of the purchases, in the terms of maintaining the stock is good or not, you are going to know by using the ratio analysis. In the same way, it is going to have a comparison of the present performance with the past performance, as I have already told. In the same way, it compares the performance against the other firms or the industry standards. You can able to take the similar firm of the similar capacity into consideration and compare the ratio of two companies in order to know where your company stands. What is your market rank of your market in the market value of the company, and so on. And at the same time, it is going to study the efficiency of the operations of your company, whether your stock is working well or not, whether your debtors are paying well or not, whether your creditors are happy or not. Like that, many efficiency of your operations is going to be understand by using the ratio analysis. In the same way, it is going to caution what is the risk of your operations of the company. Everything we'll know as we go by understanding what are the various kinds of ratios. So before going to the ratio analysis, we are going to use various kind of terms where I come to know that many BCom and BBS students are participating and MBA students are participating. Some of you are first and second and third years. So you need to know what are the basics. So part of the financial statements that we have been discussing about, basically you need two type of statements. One is the income statement or the P&L account, and other one is the balance sheet. So what is an income statement? It summarizes the revenues, costs, and expenses incurred during a specific period, usually a fiscal quarter or a year. It is the P&L statement and income statement are synonymous in nature. If you take the P&L account is an account where all the debit side all expenses and losses are recorded, and credit side all the incomes and gains are recorded. You are going to start with an opening stock on the debit side, and you are going to close by closing stock on the credit side. If you take a statement form, your income statement is going to start with the sales. You have to deduct your cost of goods sold, and you will get gross margin. Gross margin is also called as gross profit. From that, you are going to deduct all your operating expenses. What are the operating expenses? Office and administration expenses and selling and distribution expenses, which are recorded on the debit side of profit, and at the same time depreciation and amortization. You will get a operating income. It is also called as net profit. From that, you are going to add other non-operating income in the same in the way of interest, that is interest revenue, and deduct the non-operating expenses like interest expenses and other extraordinary items. We are going to get income before tax, and you deduct the tax as per as it is applicable as to your organization. You will get profit after tax. So this is how the income statement which will look like. So these are the components of your income statements. And the same way, second important statement which we need before doing the ratio analysis is the balance sheet. So what do you mean by balance sheet? It is a statement of sources of funds and application of funds. What do you mean by sources of funds? The sources of funds are what are the various ways we gather the funds for our organization. So what are the various ways who contributed to the organization is called sources of funds. Then the other part is the application of funds. How the funds have been applied in the organization. If you take a balance sheet, generally if you prepare the balance sheet in a tabular form, so the left hand part of the balance sheet is the liability, and the right hand part of the balance sheet is the asset. Generally, if you take the typical format of the balance sheet. So what do you mean by assets? So assets are probable future economic benefits obtained or controlled by a particular entity as a result of past transactions or events. So assets reflect the claim of the organization. They are the claims of the organizations. Okay. So there are two types of assets. One is the fixed asset, another one is the current asset. Fixed assets are also called as non-current assets. So what are the fixed assets of your organization? Generally, if you take the fixed assets of the organization, plant and machinery, land and buildings, furniture, vehicles, all these are long-term investments. Anything which have long-term in nature is called fixed assets. Then second one is the current asset. What do you mean by current asset of the organization? The short term or what is it? The short term the short term claims of your organizations are said to be the current assets. So what are your current assets of your organization? Your cash in hand, your cash at bank, inventory or stock or material. Again, inventory is divided into three parts: raw material, work in progress, and finished goods. Your debtors or bills receivable. All these are said to be your current assets of your organization. So the total assets are the combination of fixed assets and current assets. In the same way, what are the liabilities of your organization? The liabilities are the probable future sacrifices of economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. So liabilities are basically the obligations of your organization. The liabilities also reflect the sources of funds for your organization. What is the basic source of fund for your organization? Your owner's equity, the capital of your capital which is contributed by the owner. If it is in the case of normal sole trade and partnership company, it is called the capital that is contributed by a sole proprietor or different partners. If it is in the case of private limited company and public limited company, it is called equity share capital. So what do you mean by equity here? It is a residual interest in the assets of an entity that remains after deducting its liabilities. In a business enterprise, the equity is the ownership interest. So your liability side of the organization will have three type of classification. One is the equity, another one is the long-term liabilities, and other are outsider liabilities, outsiders funds, and the last one is the current liabilities. So equity share capital and the retained earnings forms the equity of the organization. In the same way, long-term liabilities includes preference share capital, debentures, and long-term loans, which is taken by the company. And the same way, current liabilities. Current liabilities includes a bank overdraft, which is taken by the company, creditors, bills payable, all the current obligations or short-term obligations that is made by the company, they are called the current liabilities. So before preparing the ratio analysis, it is very important to understand what are fixed assets, what are current assets, what do you mean by equity, what do you mean by long-term liabilities, what do you mean by current liabilities. So first we'll see what do you mean by current assets and current liability. So the cash in hand, the cash at bank, any asset which is of short duration, which is having a tenure of less than 1 year, is said to be a current asset. So the short-term investments, the investment which will give you a benefit, which is you are going to hold for less than 1 year. For example, 3 months investment, 6 months investment, 9 months investment, or 365 days investment. All this comes under current assets. Then marketable securities, bills receivable, accounts receivable, debtors of your organization, notes receivable, inventory or stock or raw material, work in progress, and finished goods. All these are said to be the current assets of your organization. In the same way, what do you mean by current liability? The liability which can be repaid within 1 year. I am taking a liability, have taken a loan, but I promise to pay a loan within 1 year period of time. Let us say 3 months, 6 months, 45 days, 9 months, or within 1 year. It is said to be a current liability. So what are the current liabilities of the organization? Yeah, bank overdraft, short-term loans and advances. Bank overdraft means drawing more than what bank is permitted with a accommodation from the bank. In the same way, outstanding expenses, the expenses which you haven't paid. For last month rent, I didn't pay. Or last month bill, electricity bill or telephone bill or internet bill you haven't paid. So it will become an outstanding expenses. And the same way, income which is received in advance. For example, the April 2021 income you received in the month of December 2020 itself. So, which is beyond the particular financial year. So, the income which is received in advance is also becomes a current liability because the income is belongs to some other financial year. In the same way, bills payable or accounts payable, sundry debtors or notes payable, these are become the current liabilities. So first you need to understand all these basics before doing the ratio analysis. So what are the different ways you can able to analyze the ratios? There are four types of ratio analysis and four types of ratios are there. One is liquidity ratio, and the second one is leverage ratio or solvency ratio. Third one is activity ratio. It is also called as efficiency ratio or turnover ratio. And fourth one is profitability ratio. So what do you mean by liquidity? Liquidity is the measure the firm's ability to meet the current obligations or short-term obligations. So what do you mean by liquidity? Ability to meet the short-term obligations. What do you mean by short-term obligations? You have to pay salaries to your employees. It's a short-term obligation. Why it is a short-term obligation? You are paying every month. Every month you are supposed to pay the salaries to your employees. Every month you are supposed to pay the electricity bill. You are supposed to pay the telephone bill. You are supposed to pay certain advertisement expenses. So like that, all the short-term obligations, whether you are having an ability to meet them, the ability to pay them as and when they arised. Yes, your employees every month first of October, yes, pay the salaries to your employees. You have an ability now. You paid your obligation on time, so you have good liquidity position. But there are certain companies who have not been paying salaries from 2 to 3 months. it will become outstanding expenses. That means the organization is lacking liquidity. So liquidity is the basic, the first test which is going to be conducted to analyze the financial position of the organization is liquidity. Even if you take a loan also, every month you have to pay an EMI every month. When I say every month, your liquidity position should be good. Okay, second one is the leverage ratio. Leverage ratios are also called as solvency ratio. What do you mean by solvent? Solvent means what do you say, assets. When your assets are more than your liabilities, you are called a solvent person. Then what do you mean by an insolvent? Insolvency means opposite to that. When your liabilities are more than your assets, your obligations are more than your rights. Your assets are your right. Okay, your liabilities are your obligations. When your obligations are more than your rights, you are becoming an insolvent. So whenever the bank is going to sanction a loan to you, they are going to check these two important ratios. One is the liquidity ratio, that means whether you can able to meet the short-term obligations on time or not. And the second one is the leverage ratio or the solvency ratio, where you have what is the proportion of debt and equity, whether you have an ability to meet the long-term obligations or not. Short-term obligations, the ability to meet the short-term obligations is called liquidity. The ability to meet the long-term obligations is called solvency. Solvency ratios are also called as leverage ratios. Then third one is activity ratio. Activity ratios are also called as efficiency ratios. So how do you measure the efficiency of an organization? For example, how do you measure the efficiency of an employee? Generally, you allot a work to an employee, A, B, C. A completed the work in 2 hours, B completed in 3 hours, C completed in 1.5 hours. So generally what you will say, employee C is more efficient because the less time he has taken to complete the same piece of work. But in the case of organization, how can you say they are active? How can you say they are efficient? How can you say their turnover is good? It is going to be measured by activity ratios. They reflect the firm's efficiency in utilizing its assets. So assets are not important. So how do you utilize those assets are very, very important in the organization. And the last one is the profitability. Just divide the word called profitability, profit plus ability. The ability to get the profits for the organization is called profitability. So it is going to measure the overall performance and effectiveness of the firm. Generally, hardly we are going to make all these efforts. If you are an entrepreneur, if you are running an organization, why you are putting all these efforts to get the profits? Whether you have an ability to make your profits or not will be measured through profitability ratios. These are the various things which is reflecting the financial health of an organization. Generally, what do you mean by financial health? In the case of an individual health, okay, I may be looking normal. Okay, by looks, I may be looking normal. Whether my health is good or not, how do I test? Generally, you are going to, if you approach the doctor, what is the first test that he is going to do? He is going to check your BP, whether you have high BP or low BP. If your BP is ranging between 120 to 80 as per your age, okay, you are normal, ma'am, they'll say. If your BP is fluctuating around 140 to 150, immediately the doctor will say you have a problem with high BP. The BP is below 80, like 70s or 60s, they immediately will say you have a low BP problem. In the same way, diabetics also, they will check your sugar. It should be between the normal levels. It should not be a low sugar or high sugar. In the same way, temperature. Temperature also, your body's temperature should be 98. If it is more than 98, if your temperature is touching 100 and 101, ma'am, you have a fever, you'll say. And also your temperature should not also reduce. Like that, a person's body, a person's health is being measured through various tests. In the same way, the organization's health also has to be measured by using these kind of ratios. What are these ratios? We are going to see elaborately. First one is the liquidity ratio. What do you mean by the liquidity ratio? It refers to the ability of a concern to meet its current obligations as and when these become due. So immediately as and when it has erased, I'm able to pay. So today is the last day for paying the particular bill. I'm paying it immediately. Monday is the last day for paying the transport bill. I'm paying it on Monday or before Monday itself. So that is the ability of the concern. That means you have liquid funds in the organization. So what are the various liquidity ratios that we have in the organization? Liquidity ratio gives an idea about company's ability to convert its assets into cash and pay its current liabilities with that cash whenever required. So liquidity is being reflected in the cash position of the organization, cash in hand and cash at bank. For example, you take the company's balance sheet. Company's total assets are 10 lakhs and the company's fixed assets are 9 lakhs and current assets are 1 lakh. What does it indicate? The company is having only 1 lakh to pay the funds. For example, its obligations are 2 lakhs. Yes, it has only 1 lakh in the hand. Another 1 lakh where it will get. So the total asset doesn't reflect that the organization's liquidity position is good. So you have 1 lakh. So either you have to sell your asset or you have to take a loan. Okay. So like that, you need to have proper liquid funds in your organization. So that is the first measure. So what are the various kinds of liquidity ratios that are there with us? First one is the current ratio. It is going to indicate the ratio between the current assets and the current liabilities of the organization. So current ratio is equal to current assets divided by current liabilities. The relation between the current assets and the current liabilities. So which one has to be more? Current assets have to be more than the current liabilities. For example, your current assets are 5 lakhs and current liability is 1 lakh. From the 5 lakhs, you are going to pay 1 lakh and 4 lakhs are there with you. So 5 by 1 is equal to, so current assets by current liabilities. For example, reverse it. If your current liabilities are 5 lakhs and your current asset is 1 lakh, what will happen? Your assets are not sufficient to pay your liabilities. So here, as I told you, like we need to have so much of BP, we need to have so much of sugar level, we need to have so much of temperature in the body. In the same way, the current ratio, standard current ratio, the ideal current ratio of the organization is 2:1. If your current ratio is 2:1, that means for every 2 current assets, there is 1 current liability. That indicates your organization is good. You calculate the current ratio and check what is the current ratio of your organization. For example, if your current ratio is 2.5:1, yes, you have more assets than liabilities. For example, if your current ratio is 1.75:1, that indicates that you have, it is not as per the standards. As I told you, ratio analysis is helpful for you to fix the benchmarking. In the same way, quick ratio. What is meant by quick ratio? It explains the relation between the quick assets and the current liabilities. What are the quick assets? Quick assets are current assets minus stock and prepaid expenses are the quick assets. Again, there is a benchmarking for the quick ratio. Quick ratio is also called as liquid ratio. So quick ratio or liquid ratio should be 1.5:1. It is the benchmarking for the quick ratio. In the same way, cash ratios. It indicates the cash position of your organization. So the cash ratio is equal to cash equivalent divided by current liabilities. So it should be 0.5:1. For every 1 current liability, 0.5 cash should be maintained in the organization. So remaining things are like a defensive interval ratio. What do you mean by defensive interval ratio? It indicates whether your liquid assets are enough to cover your cash requirements. Yeah. So the formula for the defensive liquid ratio is liquid assets by average daily cash requirements of the organization. So there is a benchmarking in this liquidity ratios. Current ratio benchmark is 2:1. Liquid ratio or quick ratio benchmarking is 1.5:1. Cash ratio benchmarking is 0.5:1. So you check your any company's balance sheet, you take into consideration whether these standards are met or not. If they are like according to these standards or more than these standards, the company's liquidity position is good and super. Like that, you can able to interpret by using the ratio analysis. These are the liquidity ratios. And the second one is the efficiency or activity or turnover ratios. So the efficiency of a person can be indicated by his talk, by his looks, by the way he works, like that. But how do you know the efficiency of the organization? What generally the organization does? The organization produces the goods. For producing the goods, it procures the raw material. If the raw material is converted the raw material is being procured from the suppliers. So from the date of supplier, it reaches the raw material. The raw material is converted into working process. The working process is converted into finished goods. After it is converted into finished goods, it is going to sell its products to the customers. So how that now there are two different type of sales are there. One is the cash sale, another one is the credit sale. So if you have a cash sale, there is no risk for the organization. So because you have proper liquidity in the organization, some business organizations will put a board, no credit, only cash they will say. Some organizations will entertain the goods on the credit basis. They will sell EMI facilities available. So they are selling the goods on credit basis also. If you sell the goods on credit basis, here again credit risk will occur for your organization. Credit risk is also called as counterparty risk. That means if the other party is failing to repay your funds, that is called as a credit risk for your organization. When the other party fails to repay the loan on time or the EMI on time, it is going to not only impact your liquidity position, but also impact your profitability position. So the efficiency of your organization to see whether its assets are managed properly. Who are your assets? Your debtors are your assets. You have to properly manage your debtors in a proper way. Before sanctioning the loan itself, you have to test whether your debtors have the repayment capacity or not. So these efficiency or activity ratios are also called as turnover ratios. They indicate the speed at which the funds invested in the assets are turned over into sales. So in the month of January, I started my business, and I started the production by January 15th, and I completed my output by January 25th, and I sold the goods. All the stock has been sold by January 31st. What happened? The funds which are invested have been sold. So the production has come out, and immediately I was able to make the sales within 1 month. So that gestation period between the production or the production to the sales is going to explain about your turnover. For example, you have manufactured a cake or a bakery product. What is the lifespan? It may be 3 to 5 days. More than that, it will get deteriorated. You have to throw it out. So generally, they will say they will use a word in English. We will use a word called the sales are like hot cakes. What do you mean by hot cakes? Today I prepared a cake and put it on the shelf. Immediately the customers are ready to buy the cakes. Okay, there are certain businesses like immediately the goods are being sold and no stock is going to be left over. But there are certain businesses where they are waiting for the customers to buy their products. So that is going to be measured the efficiency of your organization or the activity of your organization. So the speed, the what is it, the velocity at which your assets are turned over into sales, so that your sales will get your liquidity and profitability for your organization. So what are the various turnover ratios or the efficiency ratios for your organization? The first one is the inventory turnover ratio. So first of all, your inventory indicates whether your organization is active or not. So your inventory is there is a dust that has been formed in the inventory. That means there are no sales for your organization. Generally, every day they come clean and sit awaiting for the customers. Sometimes you go to a shop and you go to a mall, you go to a and you it will take a long queue. That means there are number of customers awaiting. So your stock, the velocity of the stock, the time taken for the inventory to convert into sales is going to be is called as inventory turnover ratio. How do you calculate the inventory turnover ratio? Cost of goods sold by average inventory. What do you mean by cost of goods sold? Two ways are there to calculate the cost of goods sold. One is opening stock plus purchases minus closing stock, or sales minus gross profit. There are two ways of calculating the cost of goods sold divided by average inventory. What do you mean by average inventory here? Opening inventory or opening stock plus closing stock divided by 2 is called the average inventory. Now, inventory conversion period we have to calculate here. What is the inventory conversion period? Time taken by the inventory to convert into sales is called inventory conversion period. So, it is calculated by using a formula called days in a year divided by inventory turnover ratio. For example, the inventory conversion period of organization X is 30, and inventory conversion period of organization Y is 20. Which organization is more efficient? Organization Y, because organization Y is taking less time to convert the inventory into sales. So that like that you can able to measure the efficiency by looking at the inventory or the stock of your organization. So if the inventory is turnover into sales, you will be happy. If the inventory, yes, you prepared something and no customers are there to buy, you either you have to eat it, or is after the elapse of the time you have to throw it out. So that is going to measure the efficiency of your organization. Next one, next part of your ratio is debtors or receivables turnover ratio. Who are the debtors? They are the persons who have taken the credit sales from your organization. They are called the debtors. It indicates the debt collection of the firm. That means what is the time period you allotted for the debtors to give back their amount. That is called the debt collection period. So generally, what is the general norm, whether you extend more debt period or less debt period? For example, a company X is there. It is giving 2 months to repay the loan. Company Y is there. It is giving 1 month to repay the loan. Which company is good in the terms of efficiency? Company Y, because within 1 month it is going to get its debt back. It is going to get its amount back. So always your credit policy has to be an optimal credit policy, so that you can able to get all your assets back. So as accounts receivable turnover ratio, you can calculate by using a formula: trade sales by average accounts receivable. What do you mean by average accounts receivable here? Opening debtors plus closing debtors divided by 2. In the same way, average collection period formula is 365 days. If you want to calculate in days, it is 365 days. If you want to calculate by months, it is 12 months. If you want to calculate by weeks, it is 52 weeks. So whatever it is, the time period divided by average account receivables turnover ratio. Whatever the answer you get, you have to put it in the denominator. So obviously, debtors turnover ratio, average collection period, lesser the average collection period, more is the efficiency of your organization. And the third important aspect is the creditors payable or payable turnovers ratio. What do you mean by creditors payable ratio? It indicates the speed or the velocity in which the creditors are turned over in relation to purchases. Time taken by you to repay to the creditors. So debtors means time taken by the debtors to repay you. But in the case of creditors turnover ratio, time taken by you to repay the creditors, to repay to your suppliers, is called the creditors turnover ratio. So the creditors turnover ratio is equal to net credit purchases divided by average trade payables. Again, the average creditors or average payables are opening creditors plus closing creditors divided by 2. That is going to be our average trade payables. So average payment period. What is the formula for average payment period? 365 days by creditors turnover ratio is equal to your average payment period. But in the case of creditors turnover ratio, if you are the owner of your organization, more the creditors turnover ratio, more will be the liquidity from your organization. For example, organization X is giving you a credit of 5 months. Organization Y is giving you a credit of 3 months. You prefer organization X because you have 5 months to repay the loan. When you are supposed to get the cash at speed, lesser time. When you are supposed to pay the cash, okay, they take more time to get the cash, so that the liquidity is balanced in your organization, in your organization. And the next one is the working capital turnover ratio. What do you mean by working capital of an organization? Working capital is the fund which is used for the daily operation, the amount of capital which is used for maintaining which is used for meeting the day-to-day expenses of your organization is called the working capital. Generally, the formula which is used for calculating the working capital is current assets minus current liabilities. So, what is the working capital turnover ratio here? It indicates the velocity of the utilization of working capital, the speed of utilization of working capital. It indicates the number of times the working capital is turned over in a course of year. It is going to be calculated by working capital turnover ratio. So, what is the formula for working capital turnover ratio? Net sales by average working capital. So here net sales means sales minus sales returns. divided by average working capital, you will get the working capital turnover ratio. So these are the various efficiency or activity ratios or turnover ratios. We have inventory turnover ratio, we have debtors turnover ratio, we have creditors turnover ratio, we have working capital turnover ratio. In the case of the efficiency or efficiency ratios or turnover ratios. The third important aspect of the ratio is the solvency ratio. What do you mean by solvency? As I already told you, the ability to meet your long-term obligations. What do you mean by long-term obligation? You apply for a housing loan. When do you pay the housing loan? After 5 years loan or 10 years loan or 15 years loan? Sometimes you will take 20 years loan also. So whether you have an ability, so you're in age, for example, your age is 25 or 37. So you have applied for a 10 years loan. That means whether the banker will test you at the age of 30, he has taken a loan and his tenure is 10 months. So up to 40 years, the next for 10 years, whether you have an ability or not, he is going to test you now itself. That means you have taken a loan in the year 2020 and you have to pay until 2030. The future is highly uncertain. But whether presently, as per the data which is applied or presented before you, whether you have an ability to pay the loan or not will be tested by solvency ratios. So the solvency ratio is the test of long-term financial position of the organization. The long-term liquidity position of the organization is called the solvency ratio. It helps us to understand whether a firm is stout enough to pay off the long-term debts, okay, or long-term loans. So in calculating the solvency ratios, there are two important aspects which we need to know. One is the outsider funds, another one is the shareholder funds. Who are the outsiders? Who are the shareholders? The persons who supply you the equity share capital, preference share capital, and reserves and surplus from the profit. You are going to transfer certain amount to the reserves and funds, and certain times you are going to retain your earnings without distributing to the shareholders in the form of dividends. So all these are said to be the shareholder funds. Shareholder funds are also called as proprietary funds or the net worth. Then what are the outsider funds? Outsider funds are your long-term loans or the mortgage loans. Mortgage loans means the loans which you have taken by pledging your asset. So you have pledged your land or a building or some kind of vehicles and you have taken a loan against some asset. They are called mortgage loans. Then the debentures. Debentures are the long-term debts of your organization, the bonds and the current liabilities. All these are said to be outsiders. So your organization's liability position, the sources of funds reflects both the outsider funds and the shareholder funds. So it is being contributed by both the people. But whose claim should be more in the organization is going to be checked in the solvency ratio. So the solvency ratios are useful to measure a company's solvency, thereby judging financial health of the organization. A company's solvency is defined by how much debt it has and its ability to repay that debt apart from the regular obligations. A levered firm adds value only if the return on investment of the project financed by debt is greater than the cost of debt. So yeah, solvency ratio, I'm going to explain you in the next slides. The first solvency ratio is your debt equity ratio. So you have debtors, that is outsiders, and you have equity, who are the owners of your company. So debt equity ratio, how much debt has been contributed and how much is equity has been contributed for the final performance of your organization. External internal equity ratio also it is called. Then it is going to measure the contribution of outsider funds and the insider funds. So that equity ratio is equal to outsider funds by shareholder funds. For example, outsider funds are 2 lakhs and shareholder funds are 5 lakhs. So that equity ratio will be 2 by 5. That means outsider funds are lesser than shareholder funds. Always it is a good indication that the company is in the hands of the shareholders. The shareholders have the right or the claim on the company. What happens if you reverse it? Outsider funds are 5 lakhs and shareholder funds are 2 lakhs. What does it indicate? outsiders have taken over your organization. Outsiders claim or right on your organization is more than shareholders or the internal people of your organization. So shareholder funds are also called as proprietary funds or net value. So that indicates whether your company is safe or not. In the same way, the next ratio is the ratio between the long-term debt to shareholder funds. What is meant by long-term debt here? Outsider funds minus current liabilities is your long-term debt. Outsider funds includes current liabilities also, but I'm taking away the current liabilities. Only I'm going to measure against the shareholder funds how much long-term debt is there. Obviously, the long-term debt should be lesser than the shareholder funds. Then next one is the funded debt to capitalization rate. What do you mean by funded debt here? The funded debt includes the debtors, the long-term loans, and the bonds of your organization. But what do you mean by total capitalization? You take all the liability side of your balance sheet minus your current assets, current liabilities, or you can say it is shareholder funds plus the long-term debt is the funded debt, total capitalization of your company. So this is going to establish a link between the long-term funds of your organization and your total capitalization of your company. Next one is the proprietary ratio or the equity ratio. So what do you mean by proprietary ratio? It establishes the relation between the shareholder funds to the total assets. Out of the total assets, which is purchased by the organization or which is maintained by the organization, what is the contribution of the shareholders' funds? For example, the total assets of your organization is 10 lakhs and the shareholder funds are 6 lakhs. That means out of total assets of 10 lakhs, shareholders' claim is 6 lakhs. That means outsider claim is 4 lakhs. Shareholders have more claim or more right on the assets of your organization. That is the proprietary ratio. It is also called as equity ratio. Next one is the solvency ratio. Solvency ratio is the opposite of equity ratio. It is 100 minus proprietary ratio, or we can say total outsider funds by total assets. What is the contribution of outsiders to the total assets of your organization? As I told you in the previous example, if your total assets are 10 lakhs, if the outsider funds are 4 lakhs, so outsiders have 4 lakhs contribution, shareholders have 6 lakhs contribution towards the assets of your organization. So lower the total liabilities to total assets, more the stability of the long-term solvency of your firm. That is called solvency ratio. Next one is fixed assets to net worth ratio. That means it establishes the relation between the fixed assets and the shareholder funds. Against how much fixed assets, how many shareholder funds are there. If the ratio is less than 100%, it indicates that the owner's funds are more than the fixed assets and a part of working capital is provided by the shareholders. Whether the shareholders have provided only the fixed assets or the part of the working capital. What do you mean by working capital? Current assets minus current liabilities. A part of it also is being provided by the shareholders or not is going to be tested by using fixed assets to net worth ratio. In the same way, fixed assets to total long-term funds ratio. It establishes the relation between fixed assets and total long-term funds of your organization. Then ratio of current assets to proprietary funds. That means it indicates the extent to which proprietary funds or equity, net worth or the shareholder funds are invested in the current assets, whether the shareholder funds are invested. Here you have to use the matching concept. What is a matching concept here? Whether the long-term liabilities or the equity capital is invested in the fixed assets and the current liabilities are invested in the current assets of the organization. How much proportion of the long-term funds or the equity has been invested in the current assets of the organization is going to be measured through this ratio. That is called ratio of current assets to proprietary funds. In the same way, most important ratio is debt service ratio. What do you mean by debt service ratio? It is going to test your debt service servicing capacity of the firm. It is going to be measured by using net profit by fixed interest charges. For example, your net profit of organization is 1 lakh and your fixed interest charges, that means you have to pay interest on a loan of 10,000. So even if you pay 10,000, your net profit is sufficient to pay your interest. Your net profit is 1 lakh, your fixed interest is 10,000. So you can able to happily pay the fixed interest charges from your net profit. So your paying capacity is good. You reverse it. Your net profit is, let us say, 5,000. Your interest is 10,000. Your organization debt service capacity is very, it's not desirable. So like that, it is going to check. The bankers are going to calculate before sanctioning the loan whether you have debt service ratio or interest coverage ratio is satisfactory or not. So these are the three ratios we have discussed till now. And the next important ratio is the profitability ratios. What do you mean by profit? They generally, for a student, the pass or fail is the ultimate outcome for the after completing the studies, whether you have passed or not. After passing, distinction gold medal is a secondary thing. Whether it's passed. In the same way, the business for the business, the test for the efficiency of your business is whether you got a profit or you got a loss. So generally, we all work together to get the profits for our organization. So the profits are the mutual measure of the overall efficiency of a business. The profits to a management are the test of efficiency and measurement of control for the organization. So there are two type of profitability ratios. One is profit margin ratio, another one is rate of return ratios. Under the profit margin ratio, we have gross profit margin, operating profit margin, and net profit margin. And we have rate of return ratios, return on assets, and so on. We are going to see in the next slides. So general profitability ratios are, we have gross profit ratio, we have operating ratio, we have operating profit ratio, expenses ratio, net profit ratio. All these ratios are going to be measured against the sales of the organization. In the same way, we have overall profitability ratios. We are going to see in the next slides. What do you mean by gross profit ratio? Where do you get the gross profit? We are going to see in the income statement. Gross profit ratio measures the relation between the gross profit and sales of the organization. So how do you get the gross profit? Sales minus cost of goods sold. Or what do you mean by cost of goods sold? Opening stock plus purchases minus closing stock. Or sales minus gross profit is equal to cost of goods sold. Like that, we can use the formula interchangeably. So whatever it is, what is the gross profit of your organization from the manufacturing activities, we are going to see in the gross profit ratio. And you can able to check your gross profit ratio of previous year to this year. In the same way, we have operating ratio. What do you mean by operating ratio? It is operating cost by net sales into 100. Out of net sales, what is the operating cost for your organization? What is the operating cost here? The cost of goods sold plus operating expenses. What do you mean by operating expenses here? All the expenses which is recorded in the debit side of P&L account. Your office and administration expenses, your selling and distribution expenses are your operating expenses. So this is the operating cost out of net sales. For example, if your net sales are 100, your operating cost is 80, that means 20 is your operating profit. So operating ratio is 80%. So you are spending 80% of your money for operating your business. So operating profit ratio, it is also called as net profit ratio. So it establishes a relation between the operating profit and sales. Operating profit is equal to sales minus operating cost. As I told you already, if your operating cost is 80, if your sales are 100, 100 minus 80 is equal to 20. 20 rupees is your operating profit, or 20% is your operating profit. In the same way, you can also calculate expenses ratio. How much expenditure has been incurred against the sales of your organization. Sales are the basic source, basic revenue of your organization. So any expenses in relation with the sales. For example, if your sales are 100, take an example, and your administration expenses are 10%, that means out of 100, even 100 rupees sales, 10 rupees administration cost is incurred. For example, your selling and distribution expenses are 25. So out of 100 rupees, 25 rupees went for selling and distribution expenses. Like that, you can able to check how much expenditure has been incurred against the sales of your organization, so that you can able to control your cost of the organization also by using the expenses ratio. In the same way, net profit ratio, it establishes the relation between net profit by sales of the company. So these are one general profitability ratios. Then overall profitability ratios are now return to the shareholders investment. Generally, why the shareholders, so generally shareholders want to know, I have invested funds, how much net profit has been obtained by the organization. Net profit after paying the interest and tax, how much I got. Every shareholder wants to know. So return on investment. So ROI, generally we'll say ROI. It is very useful in many financial analysis. So it is calculated by using net profit after income and tax, net profit EAT, earnings after tax divided by shareholder funds. In the same way, return on equity capital. Here, exclusively the equity shareholders want to know what is the return on their capital. Okay, so net profit after tax minus preference dividend. After paying the preference dividend to the preference shareholders, exclusively for the equity shareholders, how much net profit has been there is going to be tested by return on equity shares. In the same way, EPS, earnings per share, EPS they will say. What is meant by EPS? Here, the net profit after tax minus preference dividend by number of equity shares. That means what is the earning that is obtained by each and every shareholder is going to be measured by EPS. In the same way, return on capital employed. So it can be return on gross capital employed or it can be return on net capital employed. If it is a gross capital employed, that means how much capital has been invested, how much you got it. Net profit by fixed assets plus current assets. Capital employed means your capital is employed in the assets of your organization. If it is a net capital employed, net profit by total assets minus current liabilities. Direct the current liabilities, it will get the net capital employed for your organization. In the same way, capital turnover ratio. What do you mean by capital turnover ratio? Here you are going to measure the relation between cost of goods sold or the sales and the capital employed by your organization. How much capital has been invested, how much sales we got in an organization, you are going to measure by using the capital turnover ratio. In the same way, what is the turnover of the fixed assets? That means by investing in the fixed assets of the organization, how much sales have been obtained, it can be measured by using the fixed assets turnover ratio. In the same way, we have certain market test or valuation ratios. So what are the market test or valuation ratios here? Dividend yield. Every shareholder wants to know what is the yield of the dividend. So the relation between the dividends per share and the market value per share. So market is going to reflect its market value, and what is here a dividend. It is being announced by the company. It is going to be given as a dividend yield of the company. In the same way, dividend payout ratio. What do you mean by dividend payout ratio? When you got earnings per share, EPS, not all the earnings are distributed to the equity shareholders. There are certain earnings which are retained by the company. After retained by the company, the earnings are distributed to the shareholders. So out of the earnings, how much dividend is being declared by the company? For example, you got 10 rupees earnings and 10 rupees is being declared as a dividend. You have 100% dividend payout ratio. For example, you have 10 rupees earnings, but no dividend is being declared, 0 by 10. So dividend payout ratio will be 0. If you have 10 rupees earnings and 6 rupees is declared as a dividend, so your dividend payout ratio will be 60%. That means 60% of your earnings are declared as the dividend per share. So these are the market test or evaluation ratios. In the same way, price earnings ratio, it is called PE ratio, which is very, very important for the stock markets. So price earnings ratio is market price per share by earnings per share. What is the relation between the market value and the earnings of the firm? In the same way, earnings yield ratio, earnings per share by market price per share. It is just reverse of the price earnings ratio. And the last one is the market value to book value ratio. The ratio or the relation between market value per the share, what is the value that is reflected in the market, what is the value that is reflected in the books of accounts. It is called market value to book value ratio. And then we have to know about certain leverage ratios also. So what do you mean by leverage? The ability of the firm to use the long-term debts, long-term debts to give the returns to the equity shareholders of the company is called leverage or the capital structure of the company. The capital structure of the organization includes the debentures, the preference shares, and the equity shares. What is the structure? Whether the structure is built up with the outsider funds or the equity funds, how much outsiders and how much equity is going to be reflected in the capital structure of the company. So generally the capital structure ratios it is discussed in the financial management. First one is the capital gearing ratio. We are going to calculate by using equity share capital plus reserves and surplus, that is the equity shareholder funds, divided by long-term liabilities. What are the things? Preferred share capital plus debentures plus long-term loans. In the same way, financial leverage. What do you mean by financial leverage? Using the debt in order to provide the enhance the profit to the equity shareholders is called financial leverage. Using the fixed cost funds. The financial leverage is going to be calculated by using a formula called EBIT by EBT, earnings before interest and taxes, divided by earnings before taxes. In the same way, operating leverage is calculated by using contribution by EBIT. We are going to discuss all these things in the financial management. So these are the basic ratios that we have. That is the liquidity ratios, the profitability ratios, solvency ratios, and the efficiency ratios. So what are the advantages or significance? We have been discussing all these things. It is going to measure your performance. So you can able to say when, for example, I told you the what is it, the debtors turnover ratio or the average collection period should be less, the payment period should be more. Like that, you are going to measure the performance of your organization, and you are going to have a comparison between one firm to another firm and 1 year to another year. You calculate the ratios and check the performance of the company between from the last 5 years. You will know whether in which way your company is progressing or not. In the same way, inter-firm comparison is possible by using the ratio analysis. You can able to ascertain your short-term liquidity and long-term solvency position of your company. You know where you are strong and where you are weak, and you are going to have an alternative strategies, and you know your past performance, and also you can able to make your future projections also by using the ratio analysis. There are certain limitations of the ratio analysis also, because a firm's category, under which category my firm comes under. So because even though if it is a pharmaceutical sector, you see our industry, again under the pharmaceutical sector, we have many categories of firms. You have small scale, you have medium scale, you have large scale. Some are the ratios or the capacity of the firm differs with the investment of the company. Okay, tie-up of the companies, MOUs that are made with the company, like that, so on. So the published industry averages are only the guidelines, because you have to, if you have to check the benchmark, what are the published results are there, you have to take them as a benchmark. Sometimes the benchmarks may be right or wrong. And the accounting practices also, they are differing from one firm to another firm. And sometimes it is also difficult to interpret the deviations. Why it has become like that? No one can able to answer that. So industry ratios may not be giving the desirable targets, and your seasonality also is going to affect the ratios. For example, if you take the COVID time, certain time period we have to stop your operations. Obviously, the efficiency ratios are going to tell that the efficiency or the turnover of the organization is not great. Like that, your seasonality also is going to affect the ratios. Whatever it is, ratio analysis are very, very important, as they are helpful for analyzing the financial statements. They are helpful for understanding the profitability of the company. It is going to measure the efficiency of the organization, liquidity of the organization. We know what are the risks are there, whether we are going to get the risk from the debtors or from the creditors, and what type of credit policy has to be followed by the organization, and so on. For planning and future forecasting the firm also, ratio analysis are very, very helpful. So in which way, to whom all ratio analysis will be helpful? If you take the bankers, the first, when they ask you to give the financial statements, immediately a set of bankers will sit and analyze what are your cash flows of your organization, what is the liquidity or solvency position of your organization by using your financial statements. For the bankers, it is very, very important. In the same way, portfolio managers are there to project the stock prices. The financial statements analysis and the ratio analysis are important, as we have discussed about dividend yield ratio, market yield ratio, and so on. In the same way, market managers also know what is the return on the assets. We are seeing return on the sales, return on the assets, capital turnover ratio, fixed assets turnover ratio. Like that, we are going to see they are going to have a strategy for market penetration, and what is the impact on the profitability, marketing managers also, they are interested. In the same way, human resources managers, they are, in order to have a compensation analysis. For example, expenses ratios are there. What is the amount of administration and office expenses or salaries against the sales of your organization? If like that, in order to have a compensation plan also, they are using the ratio analysis. Senior management for making the corporate strategy. Sales managers, they are used for fixing the commission rates on the sales of the organization. Internal financial analysts, for preparing the profitability analysis, you will use the ratio analysis. And customer service managers, to know the efficiency ratios, that means inventory turnover ratio, data turnover ratio, like that. Customer service managers are interested in the efficiency ratios to know the efficiency of the operations of the company. Like that, there are many stakeholders are there who are using this financial statement analysis and the ratio analysis. Finally, what I would like to conclude or present my observation about the ratio analysis is the ratios are only as good as underlying data. For preparing the ratios, your data or the information should be perfect. Whatever the information that is being provided by the organization, accordingly we will calculate the ratios. And it is helpful for analyzing the correct set of financial statements, consolidated or separate legal entity. In the same way, financial statement adjusts to suit the analyst's needs before meaningful ratio analysis can be performed. So just like that, don't give away the things. So give what the figures perfectly. What are the inventory? What is the cash position of the organization? What are the debtors position of the organization? What are the total current assets? What are the fixed assets? What are the equity? Like that. If you give a consolidated figure, figure which is breakers into various parts, the ratio analysis job will be very helpful. There is no assurance that the industry right or based on similar accounting policies of the organization. Whatever it is, the ratio analysis will be helpful to all the parties, as we discussed, both the internal stakeholders and the external stakeholders, to reveal the true financial health of the organization. So with this, I would like to thank everyone for your active participation, for sparing your valuable time. And once again, I thank the management of SAB Institute of Technology, the principal Dr. Puttaraja sir, HOD of MBA, Dr. J. Mamta ma'am, coordinator of this program, Mr. Brijesh, and all the coordinators of this particular program for giving me this wonderful opportunity. Thank you, everyone.
Thank you so much, ma'am, for the wonderful session which we had today. And 1 second. Okay. So wonderful session it was, ma'am, and it was very up to the depth you have covered it about the ratio analysis. So I hope that all the participants may have been got lot of inputs from this. And thank you so much, ma'am, on behalf of our management, principal, and Mamta ma'am in her absentia, and professors who are there on the platform, and from the Department of MBA. And I thank even from the side of all the participants to enlighten us about the ratio analysis in detail. Okay, ma'am. Thank you so much, ma'am. Have a good day, ma'am.
Have a great day. All of you, thank you.
You too.
Have a happy day.
Thank you, ma'am. You too, ma'am. Thank you, ma'am. I request all the participants to join tomorrow at the same time by 7:15 p.m. on the Zoom platform. Okay. Have a nice time. Take care all. Good night.